Well, they said there's always a lot of pressure in the last act before the open bar. And I think that bar just got raised since we're running a few minutes late. But I do think we have the panel that's up to the task. And it's my pleasure. I'll introduce you to the panelists. And given the time limitations, I think we'll just get into the panel and mainly discuss the panelists' views, some of their expectations with respect to the Asia real estate investment market today. Immediately to my right is Hoke. Hoke was born in Stanley and head of real estate investing for Asia. Immediately to his right is Tripp Gantt from Washington State Investment Board. Tripp's an investment officer, real assets, and responsible for Asia property investment. And finally, to Tripp's right is Francois Trausch from GE Capital Real Estate, who's CEO of Asia Pacific. I thought we could do just in terms of our discussion, we'll start off pretty broadly and then kind of work our way down to more specific project level property investment questions. So I guess it starts off Hoke, not to start off too broadly, but would be interested to get your perspective, your view with respect to the global economic spectrum, specifically inflation, where are we headed there, and then toward that end, your view as to how you think Asia property investment will hold up and shake out in that environment.
You know, I think central banks around the world are going to remain oriented towards easing. Obviously, you'll have some big countries, vary from others. My biggest concern, I think, is the so-called risk to the upside in the U.S., where you'll see kind of a spike in growth, a corresponding spike in inflation, and then a real spike in interest rates as kind of the Fed tries to exit kind of their easing stance, which is a very tricky thing. I was at Morgan Stanley back in 1994. I remember what happened in the market overreaction when there was just kind of that shift, if you will, away from easing. From a real estate perspective in the U.S., you've seen extreme cap rate compression over the last few years that's been larger than the weak fundamentals, meaning you've had a lot of price appreciation, even though you've had weak fundamentals. That will stop when you see a spike in interest rates. Real estate does not do very well in a rising interest rate environment. It is a pretty good inflation hedge, but that's in the context of reasonable interest rates. I think, Europe, there will be austerity measures and some intensive tightening, but generally you're going to stay kind of in an easing environment. And then I think Asia is generally better off. You look at, with the exception of Japan, I would say, in that scenario. So Australia, which is another major developed market, they've just really started their easing in the last year, if you will. And if there was a big bounce in growth and they had to re-heighten, I think they have the room to do that. I think China has the ability to manage it, and kind of if growth is on the upside, that we have the ability to tighten. It varies, obviously. Vietnam, which has had some inflation hits in the last 5 years, that's less certain. Japan, obviously, they've got a long way to go before they hit their 2% inflation target, but if they got surprised and it translated into the need to tighten and raise interest rates, that's a whole other host of problems that they would have.
Thank you. I guess with that backdrop, and Tripp, you've got a good, investment perspective globally, given your role and your lens. But how do you look at property investment in Asia versus other regions? I guess today in the environment that Hoke just described, maybe give some color there, and then also maybe compare that to how you look at property investment in Asia in the global landscape versus other regions back 4 or 5 years ago when we were just emerging out of this financial crisis.
Yeah. Well, I think in our real estate portfolio globally, Asia provides a few different things. I think first it gives scale. You've got 2 of the world's 3 largest economies right here. You've got a lot of people, obviously, the world's most populous country. So you've got scale, you've got growth. You've got growth of different kinds. You've got In the emerging markets, you've got absolute population growth and economic growth. In places like China, you've got urbanization and modernization, and that's on the cycle of growth. So I think you've got scale, you've got growth, and you've got a diversity of opportunity in Asia that you really don't see in those markets around the globe. You've got developed markets in Japan, Hong Kong, Singapore. You've got emerging market opportunities, and you've got economies that are very complementary to each other. So those things together kind of make Asia kind of a fascinating place to do business. But within our portfolio, that's what we see the attributes for investing here. I think that since 2009 or 2008, as a foreign investor, one of the things you learn about Asia pretty quickly is that nothing stays the same for very long. Change happens pretty quickly. And I think probably the most dramatic changes for us as a foreign investor have been regulatory and capital markets. Just recently, the yields and the returns, even for emerging markets like China, are compressing to a level that, for a foreign investor, or someone from the U.S. maybe, sometimes it gets kind of hard to justify the returns that we're getting here for the risk that we take. So that's one of the challenges, is the constant capital market shifts, with the influx of domestic capital now in certain markets. And I think the regulatory issues, staying on top of those and trying to monitor those on an ongoing basis is always a challenge. Not just at the real estate level and where you invest in the assets, but generally speaking, how do you get your money in and how do you get your money out, and having to constantly monitor those things. And I think we'll probably talk about risks in this discussion, but our perception of risk as a foreign investor is probably going to be different in a lot of cases than that of a domestic investor. And some of that is a perception, and some of it is a risk that we have that they don't have, and the repatriation risks and things like that are something that we're always trying to stay on top of.
Thanks, Tripp. It's a good perspective from a large state pension plan that has a global real estate portfolio. Francois, I'd be interested if GE Capital Real Estate, the way you're looking at Asia, obviously you've been more active in the developed markets in Asia. I'm curious as to why that is, and again, from a global perspective of real estate investing, what are you looking for from Asia and what's driving that?
Yeah, I think maybe a year ago we would have ranked probably US, Asia, Europe. Today we probably put Asia on top. We work, for example, with the Institute PMA-TPR, you look at total returns and markets like Australia, we have a 10% total return, while maybe the US market will be a 7 and European market maybe a 5. As a matter of fact, Japan is sort of wild card, but maybe with good surprise for once. We tend to undersell Japan for the last 20 years, and I think we should forget that Japan is one of the strongest economies, and that, for example, Tokyo is the number one city in terms of GDP in the world today, and even in 2025, Tokyo will remain one of the largest cities, and so that explains why maybe from the investment point of view, we felt that Japan was a good market to invest. We had our shares of issues, because it remains a volatile market. But it's one of the markets in Asia which has probably the biggest rebound opportunity. If you look at rents, maybe 56% of peak, or prices 7% of peak. So most markets have rebounded somewhere in the world. Japan has not. And then the question is now with economics, will it change something or not? And that's what people are all thinking about. Finally, you mentioned before that the one good thing what's happening currently in Asia, at least for myself, based in Japan, but looking after Asia, is that when we were bringing an investment to our investment committee, Japan was never of big interest for international investors. It was always about China, maybe rightfully so. But for once now with economics, people take interest in the country, in the experiment that is occurring in that country.
That's, I guess, toward that end, Francois, as you guys research Asia, GE Capital Real Estate, for example, are there some markets that, from a desktop fundamental perspective, whether it's growth or other reasons, you view as quite compelling, but just practically are on the front line, difficult to make money? And then conversely, and it sounds like with respect to Japan, this may be the answer, any markets that you think others, globally maybe writing off or discounting where you think there may be some more value there, which I think you may have just answered that question.
Australia is a market which is very attractive, but not easy to invest just because the REITs over there, especially recently, became very strong. Okay, so they tend to crowd out some of the private money. You know, the Australian REITs, you know, have been very active over the last year, and so it's sometimes challenging therefore for investors from the outside to come into the market to be as fast and as knowledgeable on the market maybe as they are. Japan, I think, offers a different challenge. Japan is more, you need to be very granular in Japan. You know, every submarket is different. Every street could be different. You know, we have 120 people in Japan. That's what it takes to find the deals and be competitive against domestic capital in that market. So it's not a market where you can sort of come in and out so easily. And that's why we decided to stay, because once you're out of the market, it's so difficult to come back.
I'm sure maybe from where you sit, smaller staff, part of a large pension plan, you're looking at Asia, what markets have been more difficult to access or make money in, despite some of the fundamentals that look attractive, and any ones that you had more fortune in?
Yeah, I wish I had 120 people in my disposal. In fact, I really do. There's 5 of us running a $5 billion our real estate portfolio. But Japan has always been a tough market for us to crack, largely because of cost of capital. For an investor, it's difficult to get in there and be able to, to compete with a lot of the local capital. So, I think what we're left in Japan is maybe looking at some maybe niche industries or some place we can add value that a domestic investor might not. In China has always presented this huge opportunity for us and for everybody. But when you start to break it down to its pieces, China is not just one country. And so really trying to pick the markets that we think we can have the greatest impact with the limited number of staff that we have, and being able to come in with maybe a certain kind of perspective or something that makes us different from other investors, maybe in terms of time or in terms of structure, things that we might be able to do differently. But every market in Asia, I think, has its potential. I think every market has its challenges. I think a lot of it's going to be on the execution side for us.
Let me answer that too.
You were next.
No, just Japan. We don't have 120 people either. We do have about 40 people. And you're absolutely right. It's a very granular market. I mean, the opportunities that have been in Japan for the last 5 years since the global financial crisis have tended to be the smaller assets and portfolios, call them $50 to $100 million gross asset value. As Francois said, they repriced probably 30% plus. So you felt like you were coming in at the right type of the cycle, if you will. At the same time, if you're buying at a, call it a 7 cap rate, it depends what you're buying. But B office in Tokyo, if you're buying it as a 7, you can apply leverage and get a sub 2% cost of debt. So the play, you're creating a lot of value on the buy. You are going to sell down that asset or that portfolio, hopefully at a higher price as the market recovers, but you're paid to wait because you get a big kind of levered deal. So we've steadily invested for the last 5 years, right, through the earthquake, literally. I should say we watched very carefully after the earthquake, and it was amazing how quickly the market kind of shrugged it off, if you will. So we like Japan. The other part of your question was what looks interesting from a desktop standpoint. But I think you said maybe you're worried you can't make money. I would just say we have kind of the right level of trepidation about Indonesia, which I think is a very interesting market. We've looked at it quite a bit. If you look at it, for the last 10 years, it's kind of performed like a champ in terms of GDP growth. It's a 6% grower, kind of year in, year out, not a lot of volatility. It's got a very large, very young workforce. It's got a burgeoning middle class. There's very little leverage in the system. Since the Asian financial crisis, I think government debt to GDP is around 20. Corporates aren't highly levered. And then on the demand side, in real estate, especially for institutional product, there's a lot of demand. There is, however, potentially a lot of supply. We'll see how that plays out. And there has been a rent spike because there's date. So this is one where we're studying, we're talking to a lot of people. It really does come down to picking the right partner, I think. That's, I think, very interesting. And the other one, which is tougher, but almost as interesting, I think, because the things have gotten so bad in terms of a capital vacuum, is Vietnam, which a lot more volatile. They have had inflation, they have had currency volatility, growth has suffered. I think there's a lot that needs to be done in terms of the inefficiency at the state level. But as I said, and they have a supply problem. I forgot to mention that. But again, I think that capital vacuum, things are starting to moderate, and things are getting pretty interesting again there. So we'll see.
I guess, Hope, to continue on that theme of capital flows, are there some markets in Asia that you view as somewhat overcapitalized, despite maybe the attractive headline fundamentals?
You know, I would say the one thing I would say there is it's not always private equity that you're competing against. And residential in China is the classic kind of example there. I came into the beginning of last year, 2012, very optimistic about opportunities because the government austerity measures had been going on for the better part of 2 years. A lot of developers were under pressure. It did not mean they were going to sell things dramatically cheap or have a diluted recap, but they were showing us a lot, and it looked like some interesting opportunities. You know, some of the high yield issuers were trading at 11% high yield debt. Well, the government kind of towards the end of last year started to just take its foot off the brake, if you will, just to kind of allow kind of inventory selling and for the market to pick up. And the market just completely swung back. 11% became 6%. The bank started to kind of, lend a little bit more aggressively, and you could literally hear the window slam shut from a private equity standpoint. So that means does that mean that we're not looking at China? Absolutely not. I think there are some resi deals to be done, but really I think our focus is on commercial assets in the tier 1 cities and looking at a number of formats there. And then that same theme in India, for example, where kind of lenders it's still difficult for a developer to borrow. That similar opportunity remains in India. It's just, the door's closed in China.
I guess, Francois, in your markets where you're focused, obviously the more developed markets, are there any pockets where you are seeing overcapitalization or too much capital where it's...
We started to invest again in Japan in multifamily residential in 2010, and continue to invest throughout. And residential in Japan you buy for 5.5%, between 5 and 6%. You finance yourself, as Tripp was mentioning, at maybe 1% all in, so you get a 4% finance and arbitrage. Okay, and I think the last 12 months we have seen a lot of money coming into the market, a lot of REITs. One of the effects of quantitative easing, which is done across the world and now done on a mega scale in Japan, is that money has to go somewhere, and all that money goes where it can go, so it ends up in the public markets. And so REITs have increased by 40%, so anything they buy is accretive, basically. And so the REITs came massively into that market. And so we feel that's probably overcrowded now of that market. I think Australia, I think, is still a very good market to invest for us, so that market will continue, but more from the lending side. There are only 4 banks, so we come in and we can provide lending, which is maybe a bit different than what the banks can offer. Korea, we have operation in Korea, so that's an interesting market because it has both an inbound and outbound aspect to it. So on the inbound, meaning what can you invest in Korea? It's one of the things. It's a country in which we have made money for the last 10 years without losing money any given year in 10 years. While I think in other countries we had some years with losses. But in the meantime, the domestic investors are becoming so numerous, and so that it's very difficult to find assets to buy. And so the strategy there is more now an outbound strategy, being in Korea to bring Korean capital outside of Korea to other parts of the world.
Along those lines, Tripp, you mentioned Washington State Investment Board having a very long-term investment horizon. I mean, obviously that gives you a level of flexibility that others may not enjoy. Are there, and probably the luxury of being countercyclical and waiting things out, are there any areas or pockets where you feel is very undercapitalized, where there's the capital, that over the long term you feel very comfortable, you get risk-adjusted returns?
Well, I mean, over the long term, one of the markets that we've been interested in is Vietnam. It's been a pretty scary place for a long time for a lot of people. But the demographics are so compelling in that country. They really are. And, Vietnam is really kind of an inflection point right now in their economy where they can go kind of in the direction of South Korea, where they can kind of become another Southeast Asian country. And I think that, as a long-term investor, it made it possible for us in times where other investors have fled, and there's been a dark pool of capital in the last year in a place like Vietnam, to where if we can get it even at a small scale to get a foothold with long-term investors when we ride out cycles, that gives us the potential to maybe have good returns in a country like that and get some scale. I don't want to sit here 5 or 10 years from now and say, it's totally wrong about that. I guess that's one of the risks of being a long-term investor. But so we trade the short-term cyclical risks for the long-term direction risks, I think. And over time, I guess we'll all have to see how that plays out.
Well, Francois, you mentioned earlier about J-REITs, kind of the run that they've had. Let me turn that to Hoke. Morgan Stanley is obviously, from an investing perspective in real estate, has different arms, whether it's securities or direct property. Your focus being more on the direct side. A lot of the listed property stocks have sort of been much of the year, until actually quite recently. How does that impact how you're looking at investing opportunities on the private side? Impact your strategy, your tactics?
There's the classic ways that it does when the REITs or developers that have product or undervalued. Sometimes you'll kind of take that opportunity to take private if you think you can distribute, if you will, in the private market. Conversely, in this market where the REITs have come back absolutely in a tear from a portfolio management standpoint, you want to take advantage of that. You either want to sell to the REITs, potentially take platforms or sub-platforms public, which is something that we've done kind of throughout the cycles, if you will. So it's, and then there are some things that are a little bit more subtle, or you could put it into just trying to get out ahead of a theme. I think in Australia, for example, the fact that people are chasing yield was something that was reasonably predictable, or it has been, because you knew that interest rates were going to start to come down. Cap rates have been sticky on the upside, and typically what happens is secondary assets, secondary markets are at a yield spread to prime assets, and that's been the case kind of around the world to the extreme recently. Well, the behavior of REITs, and I've been a little bit of a aficionado of REITs over the years, is when they get to kind of this point that Australia is right now, where retail investors are seeking yield because essentially their deposits are, 4%, and if they can get steady yield at 6%, they'll really go for it. That's when you want to buy the secondary assets, kind of as opposed to the prime assets, because the REITs will come your way. So that, I think, is a thesis. It doesn't necessarily have to be the REITs. It can be syndicators. It can be any type of yield buyer. But I think that as markets recover, the gap, which is at its widest, the financial crisis between prime assets and secondary assets, that gap closes, and it's a good opportunity to make money.
Well, I guess before we leave capital flows, I want to ask one last question. I'd be interested in a brief comment from each of you on this. Which is over the next 5 years, do you look at Asia just from a pure commercial opportunity being more significant in terms of accessing capital to invest globally, inclusive of outside Asia, or do you view the next 5 years as more of an opportunity invest in Asia?
For sure, the outbound is going to be, that already started. That's a given. And it's going to be much bigger than we think it is today. It's already starting. So I think from an outbound strategy, that piece alone justifies to have a fairly significant presence in Asia to serve the rest. The inbound strategy, I think, is probably a little bit more difficult, just because there is a lot of money in Asia, and as that money becomes more sophisticated, more institutionalized, they will buy their product there. So, and then the risk is probably a little bit different from us. Not being local is all normal. The risk is always bigger, further away it is from your own base, and so I think they will have some sort of advantage on money which is further away.
Tripp?
Yeah, I totally agree. I saw an interesting report from Vallace last week that the first 5 months of this year, foreign capital flows into Asia were about $5.2 billion. Real estate capital flows. Real estate capital flows from Asia outbound were 9.5 or something like that. So it was like $4 billion gap of more money coming out of Asia than real estate investing. Bulk of that going to the U.S. and the U.K. So I think that and I find myself on a plane from Seattle to Asia on a weekly basis wondering, what the heck am I doing? Maybe I should be in another business and going the other way. But I think that tapping into finding cooperation opportunities between those two, because we obviously know the markets in the U.S. pretty well and can provide expertise, in inside track deals. Being able to partner maybe with capital sources here who might have the same perspectives domestically, I think could be a big opportunity.
How are you guys?
Well, no, I was just thinking about, I was going to make a comment of it, but something Francois said about Western investors seeing an absolute return premium requirement in Asia because of the incremental risk. And what they don't take into account is growth, sustained growth as the risk mitigant. So in kind of Western Europe, if you will, you can be stuck kind of with a flat kind of growth profile for a long, long time. Whereas in China, if you, and this is key, if you're well capitalized with it, you can weather the storm, you can be pretty certain that the market is going to ebb you out over time. And so that is it's a little bit of a self-correcting mechanism. Meanwhile, kind of the West is obsessed with the potential for kind of a monolithic China kind of resi bubble and kind of that bursting. And really that's a headline that's very difficult for them to get past. Whereas the Asian investor is much more likely to take the leap of faith and kind of give full credit to the growth that's going to occur. And it really translates into prime properties stabilized in China, where if you have a top quality mall or office building here in Shanghai, it's going to trade at a 4 cap or a 4.5 cap. And so, essentially that's like Paris or London yields. How can that possibly be, for a U.S. pension fund? They don't understand it. It really is kind of there. It's very clear that Asian investors are underwriting the growth to get to the total return that they need. Yeah.
And then staying on that for 1 second, I mean, just risk in general. Hoke, you mentioned how some of the Western investors may look at risk differently than Asia, but how they can miss investing in Asia and the domestic capital in this market. What risk do you think some of this domestic investors may be under-emphasizing or overlooking compared to someone such as yourself that's had experience in multiple markets?
So I'm not going to talk about the China resi bubble or the potential of the China resi bubble, because you do hear if you're in the bubble, you're in denial. That's almost de facto. So it is possible. There's not enough transparency really in the market. There could be that kind of those of us in the market that take a nuanced view of kind of the residential market in China. We don't believe that it's one kind of large bubble. There's differentiation between kind of the markets. What I would say is kind of a more subtle point that I think local investors are more inclined to take a leap of faith here, especially in the emerging markets. That leap of faith as it relates to entitlements for a development project, or the fact that things won't take as long as they might. They're aggressive on the time frame. They typically are more aggressive on financing judgments, if you will, that you can get financing, that you can get refinancing, that you can get a certain covenant package, so forth and so on. And that's okay as long as the market cooperates, but when the music stops, that's when it's decidedly not okay. And I think there's been kind of everybody kind of in the Western markets since the global financial crisis has really kind of de-risked their mentality a little bit in terms of kind of the amount of cushion that you need. And I think in Asia, there's still the mentality of we can figure it out if we get into a tight spot. And that's not always healthy. That can lead to a binary outcome, a bad binary outcome.
Tripp, what have you seen in terms of just disconnect and risk assessment between yourself as a U.S. investor trying to invest in Asia versus domestic capital here?
Kind of like Hoke said, a lot of it is based around the process of assessing risk. I'm not for a second going to believe that I know more about certain risks than my local partners do. I think that they probably understand the risks better than I do. I've been invested in Asia long enough now to agree with them on most of those risks when it comes to the asset level or a deal. But I think the biggest gap comes in that process, how we assess the risk, and maybe either how long it takes us to underwrite it and really understand it, or how long it takes us to get comfortable with it from a foreign investor standpoint. I think eventually we come to the same conclusions on a lot of things at the asset level and deal level. This is not including the risks associated with being a foreign investor. Again, I didn't do repatriation and things like that. But just the way that we look at this, we really try to learn a lot from our local partners. They try to learn from our perspectives as well, what we can bring to them. But again, I think it's just how quickly we move and how quickly we assess that risk is the biggest difference.
Francois, for you in Japan specifically?
Well, I'm not specifically Japan, but I would mention compliance, especially looking for an American company. We have certain rules we have to apply domestically. And again, I'm not making a moral judgment. It's more a matter of where you are in the evolution. For example, I'm originally from France. The way business got done in France in the 80s, and today it's very different. Okay, more transparent. Okay, and I think domestic investors maybe have different views on that today. That's because that's where they are in the evolutions, and so that can be disconnected between foreign investors and domestic investors.
Well, Hoke, you've now been in Asia for 5 years.
Yep.
Any, just in terms of some of the lessons learned over that time period, any piece of advice that, from a risk or otherwise perspective, that you would tell the next person coming in, or you wish I had told you beforehand?
I think what comes to mind is what I knew going in, and I have a much greater appreciation for now, which is it really is all about your partner. If you find a partner that you trust and are like-minded with, that kind of under-promise, over-deliver, I will take leap of faith with those partners. They're not easy to find. I don't know if Henry Chambers, Stephen Long are in the world, but Chongbank has been a great partner with us, developer of a project here in Shanghai. And sometimes you find yourself pushing kind of those guys to take a more aggressive view. But it also comes down to just being like-minded in terms of how you go about the business and trying to do it kind of in a high-quality way. And that really allows you to sleep at night versus situations that are not that, where you lay awake at night.
Good advice, Tripp?
Well, Hoke stole my line. I was going to say people. We always say people, strategy, and structure. That's how we invest, and people always come first. And at the end of the day, you'll find that selecting the right people up front gets you in the right places at the right time, but it also makes bad situations go away faster. It does. So really building the trust and really finding people that are only competent and have a lot of integrity and have an alignment of interest with you, I think is really the key. It's the key in any market, but particularly in Asia, where relationships are so important. Developing them over time is so important. Far and away the most important thing.
Any parting words of advice?
I have to tell you this. I mean, for sure, when I look back at our investments, investing in key cities, we're here at ULI, the key are the key cities. Each time we invested in sort of secondary cities, in Japan, for example, has not been a good investment. And so that trend is a trend not just in Asia, but even in the US, I would think. So that's sort of an ultimate. There's no exception to that rule because it's the big cities who are going to be winning over time. The second one is maybe more linked to sometimes we feel okay, we're in Asia, so it's different from the rest. So the decoupling. And the few crises we have seen show that we are in an interconnected world. And even if there's more growth here, the economies react to each other. And so you can also assume, okay, it's just different here. If there's an issue in Europe or in the US, it will hit Asia and vice versa as well. And that liquidity rise up, and as a consequence, it would be sometimes stuck with investments. Maybe, although we haven't really been involved in that, but in certain markets, good that they will come. Yeah, maybe. I mean, in most of the cases in Asia, there's a lot of strong fundamentals for it, but you have to be careful about that as well.
Maybe with that, and obviously people being a very important aspect, but just given the time, what I'd like to do is just open it up to the audience if there's a question or two. I think, John, we've got the time to field those. Well, John has limited us to 2 questions.